Index ETFs have lost their diversification. And these are ETFs that track the overall stock market indices like the S&P 500, which are the 500 biggest companies in the United States, or the Nasdaq 100 technology index. So just 5 companies account for 20% of the S&P 500 index. And those same 5 companies take up about 44% of the Nasdaq 100 index. So that becomes a problem because you buy these indices, these ETFs that copy these indices for the diversification. You want to get the broad market, you want to get all 500 stocks of the S&P 500, which is what it does. But because of the slowdown in the economy and the coronavirus, the 5 biggest companies have gotten even bigger while the rest of the economy crashes. So we're going to talk about what this means for your portfolio, because whether if you know it or not, most of your 401ks or your retirement funds probably have one of these ETFs that track at least the S&P 500 index and maybe also the Nasdaq 100 index. So you have to be aware of what you actually own without just saying, oh, I bought an index and therefore I'm diversified, because as we're seeing now, that's not the case. Hey, what's up? It's Jeffrey Lin for Stock Sessions. As always, these videos are only for educational purposes only, so don't take this as actual investment advice. With that said, most of you probably own some kind of a fund for instant diversification, whether if it's in your 401k or your IRA or some kind of a retirement portfolio. And traditional kinds of funds are the mutual funds where you pay a manager a higher fee. And the newer kind are called ETFs, or exchange traded funds. And these have slightly lower fee. But both of these, both mutual funds and ETFs, usually try to track some kind of a index. And the most common one is the S&P 500 index, because it's a broad measure of the economy. It has 500 companies, so it's a better measure of the economy than just the Dow index, Dow Jones Industrial Average, which only has 30 companies. Most funds either track the S&P 500 index or they track the Nasdaq 100 technology index. You want more stocks in the index to, one, better reflect different parts of the economy. Sometimes there's like the oil economy, sometimes there's the construction economy, sometimes there's the technology or banking parts of the economy. So a broader index with more companies in there can track the economy better, and it'll be more diversified. So if 1 or 2 companies go down, it won't damage your overall portfolio if the rest of the 400 or 500 companies still do pretty well. So that's the general idea of using mutual funds or ETFs to get instant diversification instead of hiring somebody, a manager, to pick 20 or 30 different stocks for your portfolio. You would just buy these mutual funds or ETFs. What's going on right now with the S&P 500 index is Microsoft is taking up over 5%. Apple is taking up about 5%. And Amazon, we use yellow. Amazon is taking up about 3.7%. And you have Facebook, let's use blue. Facebook taking up 1.86%. Google taking up 3.24%. The total of these 5 companies take up almost 20% of the index. So you have 20% of your diversified portfolio concentrated in these 5 conglomerate big technology stocks, and they all kind of have similar business characteristics, so they're all susceptible to the same economic conditions because look, Microsoft is heavily reliant on business. Apple is also, Amazon with its cloud and AWS is also really dependent on businesses. Facebook, and Microsoft, and Google all depend on advertising. And Amazon's probably the only one that also has a lot of consumer and retail. But all in all, most of these 5 companies are highly related. So there's not much diversification if you're 20% of your portfolio is concentrated in 5 stocks that kind of seem like just one big stock. How about in the Nasdaq 100, which you can buy with the ETF QQQ. With Nasdaq, Microsoft takes up 12%. Apple takes up 11.2%. Amazon takes up 9.6%. And Facebook, let's see, Facebook down here, Facebook takes up 4%. And Google takes up about 8%. So these 5 companies take up over 44% of the Nasdaq 100. This is everybody else. This is 95 other companies over here. And even if you really like these companies and feel they're really important to our modern technology economy and just the infrastructure of the world, these 5 companies are too concentrated in similar types of businesses. So portfolios like this start to get a little bit dangerous because you're so concentrated and dependent on these 5 companies doing well and performing to perfection. And because so many of these funds, ETFs and mutual funds, so it's basically everyone's retirement and pensions are funneled into these 5 stocks. So there's not a whole lot of room for these companies to grow. That means there's not a lot of money that could come in and buy these stocks and push them higher. So that becomes a problem when you're so concentrated in just a couple of stocks. We'll jump over here to a blog called The Irrelevant Investor. Anytime the top 5 stocks dominated too much of the index, there was a stock market crash coming right after. So like here in 1999, the top 5 stocks took up 16.6%. And right after 2000, you have the dot-com bubble burst, and the Nasdaq fell more than 70%. And in 2008, that was right near the housing crisis and the financial crisis. So you see the top 5 stocks in 2008 took up 14% of the pie. And right now, again, so we're looking at here in 2020, and we have the top 5 stocks taking up about 20%. It's too dependent on one side, and if any one of these 5 companies starts to slow down or have problems, then they'll drag the rest of the index down, and it'll drag your pensions and your portfolios down. So finally, I want to do a quick example of how this could blindside you in your portfolio. Let's say you already had the QQQ ETF and you have, let's say, 80% in the QQQs in your retirement. But remember, 12% of the QQQs are in Microsoft. That means of your total portfolio up here, you own 9.6% of Microsoft in your overall portfolio. So let's say in the remaining 20% of your portfolio, you also buy Microsoft. So over here, you have 20% of Microsoft. So combine these two together, and you have 29.6% in Microsoft. So you are way overweighted in just this one stock.